Hello, everyone. Good morning, and thanks for joining our monthly update call. It's a pleasure speaking to you all. We have a very good audience and attendance today. So let's start with it. I hope all of you are able to see the screen that I'm sharing. Has a few slides that we can go through. This is what I plan to discuss today. First, obviously, like any given day, there are opposite views, both on the bull side as well as on the bear side on the US economy. Our portfolio, although it's about 70-75% US and the other 25% is non-US, we still rely a lot on the US economy. And so that's why we will discuss the bull thesis, the bear thesis. What are the bulls saying? What are the bears saying on the macro front? Then we will discuss what is our view on which side of the table do we fall, whether on the bull side or the bear side. Finally, on the macro front, we will also discuss how we are positioning the portfolio for our scenarios, the bull and the bear scenarios. So those are the three main things we will start with. And this will include discussions on the Fed rate cut, the tariffs, the fiscal stimulus, the one big, beautiful tax bill, as they call it. And last but not the least, we will discuss AI deployment scenarios and use cases, because I think that's a space where, irrespective of how the economy does, I think there is a high probability of growth over there going into the next few years. And finally, we have some stock case studies. We'll go through them fairly quickly, unless you guys have any questions. And I want to keep this very interactive, so as far as questions are concerned, please feel free to type them into the chat box on the webinar. And one of our associates, either Aishwarya or Shrestha, will ask those questions as soon as we are done with the first 10-15 minutes of me talking through the US economy and other items on the presentation. All right, so now with that out of the picture, let's start with the bull and the bear views on the US economy. So as far as the bull views are concerned, we'll start with that. One is obviously the monetary stimulus, which is a 25 basis points rate cut is now almost a certainty. The options market is giving a 90% probability to a 25 basis points rate cut in September meeting for the US Fed. And most of the times, the US Fed's analysis by the options market has been fairly accurate. And so, yeah, 25 basis points rate cut is almost a certainty. Now there are even talks about a 50 basis points rate cut, which will be very stimulative if it does happen. So we'll see. Now our expectations are somewhere between a 25 to a 50 basis points rate cut in the September meeting. And the next meeting is in September. There is no meeting in August. So that's monetary stimulus, which is a big deal. Obviously, rate cuts typically are very good for stock market returns. And then the other theory that the bulls put forward is the fiscal stimulus. So we talked about monetary stimulus with the rate cuts. Next is fiscal stimulus. The one big beautiful tax bill, which was just passed as a law about 15 days back. I think that bill has quite a few provisions for tax cuts, both for corporates as well as individuals. We'll get into some of those details in the later slides. But that provides a lot of stimulus to the US economy. So that's another reason why the bulls are arguing that the stock market's returns will be quite positive over the next couple of years. And last but not the least, the EPS growth of US large and mid caps, it's pretty robust. We are expecting a 9 to 10% EPS growth for CY25 and slightly lower, but 8-9% EPS growth for CY26. So given that type of EPS growth, I think it's, and including the fiscal and monetary stimulus, it sets up a good environment for decent stock market returns. Historically, when both fiscal and monetary stimulus are combined for any economy, forget the US economy, it is very bullish for the stock markets. And it's almost an unbeatable formula for good stock market performance. So it's a very potent combination when you have monetary as well as the fiscal stimulus, which we are going to see in the next 1 year or so. It is just the beginning, and it will be implemented over the next 1 year. So a wonderful setup for good stock market returns. Now, on the bear side, a lot of bears argue that inflation is going to be higher from the tariffs, although we'll discuss later on why it doesn't matter in the near term, and over the long term, the companies do get a chance to adjust their supply chain. And so the impact of tariffs will be blunted, but yeah, there will still be some impact. You can expect some sort of price increases for US goods, for US consumers. And that is why inflation will increase, and that will likely reduce some of the discretionary spending. As prices increase, people reduce their discretionary spends. So that is the bear thesis, which definitely that will work out. Now, up to what extent it'll work out, that's the only question. The next point put forward by the bear camp is net new job creation. The jobs report released yesterday was 73K new jobs created versus 104 that was expected. So that's a negative. And both April and May jobs were revised lower by a significant amount. So that's also a negative. Most of these job losses, because this 73,000 number is a net new job creation, which means any job losses that happened during June were a negative to that number. And most of that negative number came from government sector layoffs. Dodge, which was the Department of Government Efficiency, which was headed by Elon Musk till he left, that was responsible for a lot of layoffs in the government sector. And that is impacting the jobs numbers that you're seeing right now as a net negative. Housing starts are declining. Housing is a big part of the US economy. So declining housing starts doesn't bode well for job creation. Obviously, that is also hurting the job creation. And subsequently, those are the few points that are put forward by the bear camp. However, as far as BayFort's view is concerned, we do feel that the monetary and fiscal stimulus will overpower the negative effects of the inflation, lower job creation, as well as lower housing starts. And finally, a lot of this, whatever the bears are claiming, has already played out. For example, jobs, they're already declining for the last few months. Housing starts are already declining for the last few months. Some of the inflation has also been factored now. So a lot of the bad news is already factored in, while the impact of the fiscal stimulus, which is the tax bill, is just 15 days old. So that hasn't seen or is not seen in the economy as yet. And we'll discuss some of the major impacts of that fiscal stimulus bill. And on the monetary stimulus, September is still about a month and a half, 2 months away. The Fed meeting in September, and that obviously has not played out the rate cuts. So once the rate cuts are implemented, then we will see the impact of that on the economy in the next 6 to 9 months. And so I think while all the bear theories have already played out in the stock market or in the economy, the remediation to that, which is in the form of fiscal and monetary stimulus, that has just started. It's a 15-day-old story, and it is going to continue for the next 1 year. So I think as that story takes hold and the impacts of the fiscal and monetary stimulus are seen in the economy, the stock market will definitely, I am expecting the stock market to react very positively to the stimulus measures. So that's our view between the bull and the bear case scenarios. So now, given that we are in the bullish camp, obviously, we still have to be careful about what are some of the issues that some of the sectors can face. Because if we expect that consumer spending will decline, then there is a high probability that the consumer discretionary sector will face some headwinds. And so we have been cautious on the consumer discretionary sector within our portfolio. So obviously that is a place where we have reduced our exposure over the last few months, and going forward also we may reduce or even further cut or rather not add to our exposure to the consumer discretionary sector. Travel and tourism will be in the penalty box for quite some time. Higher inflation will will reduce the consumer discretionary spending. It will hurt job creation. It will hurt housing starts. So housing is definitely a negative in the near term, next 2-3 months. So I think we'll be careful about all these sectors. On the positive side, we think the AI beneficiaries, for them, a slight reduction in consumer spending or slightly higher inflation or lower job creation or housing starts may not matter a whole lot. So, and we have seen that from the results we saw from the heavyweights like Microsoft, Amazon. They don't seem to be impacted by higher inflation or housing starts or anything like that, and they are continuing with their capex program. So anybody that's a beneficiary of the AI trend, we think they will likely continue to do well over the next few months while we are grappling between this bulls and bears. On the healthcare side, obviously there is very little impact from any of this, so there we are also not very positive but definitely not negative, so you can say neutral on healthcare. Consumer staples, again, neutral, not a big issue. I think staples are staples. During any cut in discretionary spend, staples do well. They are not a problem. Defense is a big theme that we are looking at right now because obviously America wants to balance its trade deficit. And one of the easiest way to balance trade deficits is tariff. The second best way is to increase exports. And US is not going to be exporting shoes or clothes anytime soon. So what it can export is defense equipment. And so we are positive on the defense equipment sector in the US. So these are some of the puts and takes. This is how we are thinking about the portfolio, about where we should increase and decrease our allocations. So now moving on to the next part, which is what are some of the details and why we think that the bull view will prevail versus the bear view. On the fiscal stimulus side, the one big beautiful act that is now the law, it permanently made the corporate tax reduction to 21%. It used to be 35% till it was reduced by the first Trump term. And that was going to expire in this year. So corporate taxes, if the One Big Beautiful Tax Act was not passed, corporate taxes would have gone from 21% to 35%. Now that is not going to happen. Other things like immediate expensing of R&D expenses, accelerated depreciation is a big boost to the cash flows of a lot of companies in our sector. Some of them that I have mentioned over here are Google, Microsoft, Apple. You can see in 2025 itself, it amounts to about $75 billion between these 4 companies, or rather 5 companies. That's the cash tax flow benefit in calendar year 25. For these 5 companies, it's about $75 billion. The largest beneficiary over there is Google. You can see at about 35 or slightly less than $30 billion. So just to give you a comparative idea, Google's annual cash flows that it generates is at an average of $60 to $70 billion. Just from the tax cuts this year in CY25, it will get anywhere from $25 to $30 billion additional cash flow. So roughly 40% of their annual cash flow is they are going to get additional cash flow from the One Big Beautiful Act tax bill itself. So you can imagine how potent this is. Now, the next question is, so what will they do with all this money? A, it will go in share buybacks. B, it will go towards developing AI capabilities in terms of hardware, software. So I think two major beneficiaries from the money that the government is going to provide to these companies in terms of tax cuts: A, stock buybacks, and B, capex on AI hardware and software. We did see Microsoft increasing its capex budget for this year as well as next year. In their earnings call, they did announce that they're going to increase their capex budget. I think it was increased by about 8%. Similarly, we saw higher capex from Google also. And so you're already starting to see the impact of that. And I think this will continue for the rest of the year. To a certain extent, the OBBA, which is the One Big Beautiful Act, helps in consumer spending because it eliminated taxes on overtime and tips up to $12,000 per year, so which helps the lower end of the income population. Plus, there is no additional. Plus, they provided some additional child tax and state and local tax deduction credits to homeowners and obviously families with children. So I think that will help to a certain extent. It was negative for EVs. They eliminated the EV credit of $7,500 per car. So for a car of, say, it was for cars above $50,000 or something. But for, say, a car of $50,000, $7,500 as a credit, EV credit, is a huge deal. So that's a big negative for Tesla. US Tesla sales will definitely slow over the coming year. There's no doubt about it in my mind. So that's as far as the OBBA is concerned. So that's why we feel this is a huge positive from a pure cash flow perspective. Forget everything else. To a lot of the companies in our sector, some to a larger amount, few others to a lesser amount, but in proportionate terms, it is equally good for all of these companies. So anywhere from 20 to 40% of their cash flows will be added just from the tax cuts from the OBBA. All right, moving on to the tariff impact. I think anytime a government introduces a policy which is a sudden change. So the tariffs were a sudden change till 1st of April, when there was and almost the administration only gave 7-8 days because they announced it on the 2nd of April, I believe, and the implementation was going to be on the 9th of April. So that is too short a time for the industry to change their supply chain. But then later on, the administration provided another 3 months for implementing tariffs, and then they further extended it by another 3-4 months for a lot of countries. So I think that helps everybody. So if you get 6 months, then you, as a company who's based in the US, who's importing stuff, they can easily adjust their supply chain. And you can see that in the top chart over here, US was already adjusting its imports from China before 2024 also. So since 2018, US has reduced its imports from China by a wide margin that you see on the top right-hand side chart. And in 2025 also, you will see that Chinese exports to the US have taken a straight slide down. Now, some of that is made up by increase in exports from Vietnam, Mexico, Canada, other countries, but definitely exports from China have declined. So even in 2025, the supply chains have been readjusting so that they are reliant less on China. So once companies get this time to readjust the supply chains, the impact is reduced to quite an extent. And I think that is what we'll see over the next 1 year, that companies have gotten enough time. And that's why the impact of tariffs will mostly be blunted. And plus, people have bought ahead of time. A lot of consumers, a lot of businesses, you can see that in the inventory numbers for Amazon, Walmart, all of them. They have increased their inventory significantly. And so that is why the tariff impact, at least for the next 6 months, will be zero. And then after the next 6 to 8 months, when the current inventory does get sold and you have to buy new inventory, I think at that time you will see some impact on prices from the tariffs, but it may not be as much as it was feared initially. So that's why I think tariffs is probably not a big issue in the markets right now. That brings us to our sector, which is a large part of our portfolio is invested in AI. And as we discussed, a lot of the monies that these companies are getting from tax savings are going to be deployed in improving their AI capabilities. What are some of the biggest beneficiaries of that within AI? I think the first and the easiest one is customer service and marketing and sales. This is where you are likely to see a lot of automation from AI agents. We are already seeing it. If you haven't used Amazon Rufus, I encourage you to use it. You can use it on their Amazon app. You can ask a question to Rufus, saying, I want a particular item, and give a description, say, I want shoes of this color, this size, and you don't have to do a search on Amazon's website. The Rufus AI agent will do it for you. So you're already starting to see usages of that, and that will just continue to improve and increase. So customer service, marketing, sales, all these are the first few applications that you're likely to see in terms of AI. And so that will continue to grow and improve. And it's almost a frenzy. The number of new large language models or updates to large language models that we see on a daily basis is just crazy. So the improvement is so fast over there that if you think the current agents are good, the next generation of agents in the next 6 to 9 months are going to be phenomenal. So that's one place where I think we'll continue to see growth. So we have also tailored our portfolio to benefit from this growth. Yeah. Next, what are some of the sectors that are going to see growth? I will not go through all the details over here. You have access to these slides. If not, just send an email to us and we'll be more than happy to share these slides with you. But all these sectors, I feel, are beneficiaries of AI to quite an extent. And irrespective of how the economy does, there is going to be growth in these sectors. It may slow down a little bit, but not by much, because there is heavy competition from companies in each one of these sectors. So if you want to stay in the competition, then you have to continue innovating, especially in lean and mean times, if we do go through one. So I think these are the sectors that we are focusing on in our portfolio, and we should see good growth over the next few years, no matter how the economy does. These are some of the case studies that we have been through in the past. I'll let you read through it for most of the part. This is Oddity Tech, is an Israeli company. The founders of Oddity Tech are from the Israeli Defense R&D unit. So I think they used a defense application for consumer purposes, and they have formed a company around it. They do a lot of cosmetics. They sell cosmetics online. So far the problem was cosmetics you could not sell online because the shade of the skin color is very important in cosmetics. And that was something that nobody was able to crack. And for that, people have to go to a beauty store or a mall where they can see the shade of the cosmetic that they want to buy. But now this company, with the help of AI, has been able to crack that part, and a regular phone camera can click a picture of a consumer and tell what is the skin color that will match from the hundreds of shades of skin color that a cosmetic company has online. So they are the first ones to crack online sales for cosmetics. And so I think they are likely to continue to win in this AI race. And so I think we are quite bullish on this particular company. Apart from that, I think let's move on to the next one. Next one here is Sea Limited. This, just to give you an understanding from an Indian context perspective, in India, if you think about Flipkart combined with Paytm, combined with Bajaj Finance, combined with Nazara. So you have e-commerce, you have payment, you have short-term financing, which is Bajaj Finance, and online gaming. All of that put together in a single company. So even these individual sectors are high growth sectors in most of the countries. Imagine all of them put together. And so that is the case with this company, and it operates, it's a leader in Indonesia, Malaysia, Vietnam, all these China plus one beneficiaries. And so we are really bullish on this company too. The management is phenomenal. Their track record is excellent. They have been competing with Amazon for 10 years, and Amazon is still not able to beat them. So you can imagine the quality of the management team. So we definitely like this stock, Sea Limited. The next one is Mercado Libre. This is an exact carbon copy of Sea Limited. But they don't operate in Asia Pacific. Mercado Libre operates in Latin America. So their major markets are Brazil, Argentina, Mexico, Peru, Chile. And I think Mexico is a big beneficiary of this trade war because Mexico is the closest to the US. They have obviously road and rail networks connecting to the US. And so that's the closest you can get to in terms of production before putting up a plant in the US. And so I think Mexico is a big beneficiary of this theme of global trade wars because they are the closest to the US. And that's one of the reasons we are very positive on entire Latin American economies. All of these countries, I think they're going to grow very well. And Mercado Libre is again a leader in e-commerce, quick commerce, fintech, consumer credit, banking. They also have a banking license in Mexico. So it's a combination of a bank also in those regions. So all high growth sectors, all good moats for the company. And so, yeah, we think they are likely to do very well. So Mercado Libre, we are very positive on. Moving on to the next stock. Novo Nordisk, they make the famous weight loss drug, which is Wegovy and Ozempic. And this stock has got into a little bit of trouble off lately. So they have not done well in the last couple of months. But overall, we do feel that this company will do well because as of now, there are only two competitors in that market. It's Eli Lilly and Novo Nordisk. And I think this market is big enough that the market can handle 10 competitors. So two competitors in such a market where obesity is a problem worldwide, it should not be a big problem. So while in the near term, Novo Nordisk is facing some headline risks and the stock has not done very well, but we do feel for the long term, it is a good stock. In the near term, there are no major catalysts. So I would not expect the stock to shoot up immediately unless something out of the blue comes up. But over, say, beyond the next 6 months, I think there are good chances of the stock doing quite well. So I think we are still positive on Novo Nordisk. And I think that was pretty much it on my end. Now I'll go to the questions here. Let me see what questions we have. I think if Aishwarya, if you can hear me, please go ahead if you have any questions on the chat box. Okay. I see a question over here. I'll read it myself. I think Aishwarya may be having some issue with her microphone. So yeah, the question is Tesla's robotaxi model, and how risky is it in terms of I think probably around revenue generation, and what is your opinion on the 3-year stock outlook for Tesla? I think Tesla, it's definitely not priced as an automotive stock. It's priced for being a taxi operator. While there's no doubt in my mind that one day it'll become a taxi operator, but they have been talking about introducing taxis since 2018. And last month was the first time when they introduced a very small concept of a taxi and a small trial in one single city in Austin. So it is difficult for us to project that they will do anything big on the taxi side in the next 1 year. So if you're looking at a 3-year time horizon, maybe they will have a taxi. But if you're looking at the next 1 year, I highly doubt it. And the other problem with taxis is that it's a state-by-state approval that you need. So it's not like you have a successful taxi operation in Texas and within 6 months you can have taxis all over the US. That's not going to happen. You need to go to every state, show them some data, and each state, the approval process could be 6 months, 12 months. So I think it's a long process. And if I were to give an estimate, I would not expect Tesla to have any major taxi operations in more than a couple of states over the next 3 years. So beyond 3 years is a little bit too far to project and buy stock in that expectation that, okay, 5 years down the line, they will be the major taxi operator. While that is possible, but we cannot buy stocks based on something that is going to happen 5 years from now. I think that's a big issue that we are facing as far as Tesla stock is concerned. And so not very bullish on Tesla. And if things change, we'll see. But as of now, nothing much. We need to see some proof of the robotaxi working first in a few cities, and then potentially we may pay a premium, but then it might be worth considering buying that stock. But till then, we are probably not very bullish on Tesla, right? Which companies in our portfolio are from the healthcare and the tech side? I think we discussed a few companies over there. As far as tech is concerned, we definitely have NVIDIA in our portfolio. Some of the large name Microsoft we have in our portfolio. So those are some of the tech names. Healthcare side, we discussed Novo Nordisk is there in our portfolio. So all these names are, I think, quite liquid names to put a bet on in terms of healthcare as well as technology. So these are some of the names that we have, and I think Viva Systems is another name that we have in our portfolio. They are a healthcare company too. They provide software for healthcare companies, so we like them too. So these are some of the names that we have, and I think irrespective of the economy, these stocks, we are quite confident they should do well. We are not worried about it at all.
Thank you so much, sir, for this question. Sir, we have some questions from our attendees. It is regarding to the portfolio. So one of the attendees are asking that could you elaborate what is exactly BayFort Global Leaders portfolio is? Could you share your opinion, some lights on it, sir?
Sure. So our portfolio is a concentrated portfolio of about 20 stocks, and we invest only in disruptive technologies around the world. So we scour the globe. We go around the globe every day looking for disruptive and innovative companies. And we try to keep it 70% in the US and 30% outside of the US. So we talked Oddity Tech in the slides. That's an Israeli company. We have Novo Nordisk is a European pharmaceutical in our portfolio. We have a Canadian company, C Limited. We discussed that's a company operating out of Indonesia, Malaysia, Vietnam. We have Mercado Libre operating out of Brazil, Mexico, Argentina. So all these names form the 25-30% of our portfolio, and the other 70% is in the US. But one common thread across all these companies is they should be doing something disruptive or innovative. It doesn't need to be in tech. Like at one point in time, 1.5 years back, Tesla, or rather 1 year back, Tesla was also a part of our portfolio because Tesla is disrupting the automobile industry, and it is truly a disruptor in that industry. So I do feel that if we have more confidence in Tesla, we may get back into it. But as of now, not so much. But that's an example about how Oddity is an example in the cosmetic space. They are disrupting the online cosmetics industry. So we look for disruptors in every industry and invest in them. And that's our portfolio. Go ahead, Aishwarya, with the next question.
Yeah. Thank you so much, sir, for this. Another question we have. So they want to know that what is the minimum requirement, what is the minimum investment requirement for this product, and also is there any lock-in period or exit load?
Okay. Yeah, easy ones first. There is no lock-in period. There is no exit load. There are no charges like that, custodian charges or account opening charges or nothing like that. It's a pretty straightforward, simple and transparent product that we offer. As far as minimum ticket size is 10 lakh rupees for Indian residents, and for everybody else, it is 25,000 US dollars. So that's the minimum ticket size. Go ahead, Aishwarya, anything else?
There is a client question also. What about the threat of illegal compounded drugs to Novo Nordisk? So there are any other?
Yes, absolutely. So Novo Nordisk, that is a big threat to so what, to give context to everybody else who's not following Novo Nordisk, Novo Nordisk has a patented magical weight loss drug, which if you take that drug in 6 to 9 months, you can lose 25% of your body weight, or 20% to be fair. So a 100-kilogram person can become 80 kilograms within 6 to 9 months without any major side effect. So it's a wonder drug. There are no major side effects, and it has been tested for a long time. So it's a wonder drug. Absolutely. You don't have to go to the gym. You don't have to worry about anything. But there are some illegal compounding that is being done, and they are sold as a weight loss drug, which is the drug itself they try to replicate. It's like a generic version of the same drug. Now, that was allowed till 2 months back because in the US, there is a rule that if there is a shortage of any drug, the Federal Drug Administration, FDA, they allow duplicates or generics. But that shortage went away 2 months back. And so now compounding is not allowed. And so both these companies, Eli Lilly and Novo Nordisk, are going to fight this compounding tooth and nail, and they will stop the compounding because their drug is patented up to 2031. And they definitely will not allow any compounding. So I think they are already fighting it, and compounding has reduced to quite an extent, and it will reduce further. I think while it was a concern in the last 1.5 years, it is not a big concern over the next few years. Go ahead, Aishwarya, Shrestha, any other questions?
Okay. So what are the key risk factors other than the rate cuts that are you looking at? Are there any valuations or expensive valuations of the companies? Because we are forecasting these profit growths. What are the other factors?
Certainly. So yeah, I think valuation is one of the things we consider. And that is certainly, in some stocks, it's an issue. So if you look at AI stocks, some of the AI stocks, they are trading at crazy valuations. But outside of that small segment of AI stocks, I don't see the valuation as crazy. So that's why we are not too worried about the valuation. It may be slightly above average, but unless you are like 2 standard deviations away or 1.5 standard deviations away from average, you should not be worried about valuation. So we are not worried about valuations for most of our stocks. Some of the stocks, obviously, they are trading at crazy valuations, but we avoid them in our portfolio. So as far as including or choosing stocks for our portfolio, there are enough options, and valuation is not a problem. Go ahead. Next question, please.
Okay, so according to this valuation question only, another concern about a client is, do you see any concerns on the US market valuation, which being highlighted as a direction where Berkshire Edge holding large cash of pile seems like higher than ever? So any
Okay.
concerns over there?
Yes, fair enough. That's a question that a lot of people are worried about. But if you have followed Warren Buffett and his newsletters, he had written extensively that whenever he retires, he would like his next CEO of Berkshire Hathaway to start with a clean slate. And he has explicitly mentioned that he will sell all the holdings for which he was responsible for in a phased manner, so that the new CEO can start with a clean slate. Because if a new CEO joins Berkshire Hathaway and he sees that Warren Buffett had selected all these stocks, it will be very difficult for him to sell, right? How can you disagree with Warren Buffett? That's something as a CEO you will not be able to do. Even if you disagree, you will not be able to do it. So Berkshire Hathaway, in his newsletters in the past, going all the way 10 years back, because there have been rumors about Warren Buffett retiring for the last 10 years. He has clearly mentioned that whenever he retires, he will make sure there is a large cash pile available for the new CEO to deploy in the stocks that he or she likes. And that is why I think now we understand why, especially after he resigned that day, we immediately understood that why he has such a large cash pile, because he wants the new CEO of Berkshire Hathaway to make his own investment decisions and not be clouded by the existing portfolio, which was set up by one of the best portfolio managers in the history of portfolio management, right? So the new CEO will not have that burden on his head that he is disagreeing with with Warren Buffett, so he can start from a clean slate. And I think that's the big reason why Berkshire Hathaway has a large cash pile right now. Go ahead, next question.
So, investor is asking if he's adding on the money today. The stocks like mega stocks like Microsoft will still be added into his portfolio?
Yes, absolutely. We have the same portfolio for everybody. So the exact same portfolio that the existing investors have, the new investor will get the exact same portfolio. And the reason being that if we think that, say, a Microsoft is overvalued, we would have reduced or removed it from the portfolio already. The fact that it is still there in the portfolio, it shows that we believe that there is still upside in that stock. So you are not losing anything by getting in late. Obviously, you lost the past returns, which we cannot replicate, but it doesn't mean that here on everything is expensive in the portfolio. I'll give you a very good example. 1 year back, Amazon was about 13% of our portfolio. Then we started seeing that Amazon was getting expensive, and we also saw some headwinds to the Amazon stock. So we have reduced it significantly now. It's less than, I think, 2-3% of our portfolio right now. So if you got in 1 year back, you would have gotten Amazon. If you get in right now, Amazon is almost a very small part of the portfolio. So if we feel that something is overvalued, or Tesla is a very good example. 1 year back, Tesla was in our portfolio. Then we saw that it got overvalued. So we sold out of it. So anything where we feel the upside is not there compared to the risk, it's already out of the portfolio. So whatever is there in the portfolio has a decent upside. Only then it will be there in the portfolio. So you are not losing out in terms of getting in the portfolio at any given time. So I don't see that as an issue as far as entry point is concerned. Go ahead. Next question.
Okay. So, what are your views regarding Guinness's and Clarity Act?
Sorry, I didn't get that question.
Question is regarding Guinness's and Clarity Act. Do you have any Guinness's and Clarity Act? Any regards regarding questions regarding that? Your views regarding that?
The Genius Act, you mean to say, that was signed as a bill of lately, I think.
Correct.
Yeah, okay. I think it doesn't impact us a whole lot. It was mostly related to payment companies and stable coins being a regulated entity now. So it'll impact the payment companies like MasterCard, Visa, PayPal, but not the entire economy or anything like that. I think what we understand is that it increases the demand for US Treasury because they made stablecoin regulated, which means now anybody can buy stable coins. Stablecoin is a type of crypto coin which is backed by liquid assets. And if you want liquid assets, the most liquid assets in the world right now are US Treasuries, short-term bonds and T-bills, right? So 2-year bonds, 3-month bonds, 6-month bonds, these are the most liquid and stable liquid assets. So most of the stable coins will be backed by US Treasuries. So it will increase the demand for US Treasuries, which means it will allow US government to issue short-term debt. That is one big objective of stable coins and regulating stable coins in my mind. And so I think it's a big positive for allowing US to issue more debt at lower rates because it is more short-term. 3 months to 2 year is kind of the time frame where most of the bond buying will be there from stablecoin holders. And so that's the only major impact. Apart from that, I don't see any major impact to other companies in our universe. So, next question.
Okay. So the next question is specific to the portfolio. Why only large cap? Are you interested in small cap or mid cap any time soon?
Okay. So large cap, there are many technical reasons and there are some fundamental reasons. We'll start with the easy fundamental reason. Whether a company goes from $1 billion to a $10 billion or from $10 billion to $100 billion, the return to an investor is the same. We focus on companies about $10 billion. So we expect that $10 billion company to go to 50, 70, 100 billion. Now you can buy a $1 billion company and expect it to go to $10 billion also. Your returns will roughly be the same. So from a returns perspective, I think we are good. But the chances of failure of a $1 billion company is quite high. There is a whole laundry list of $1 billion companies failing in India also. Forget the US, right? So a $1 billion unicorn going bust is very easy. Compared to a $10 billion company going bust, the chances of that are very low. Because at $10 billion, you have a proper 10,000, 15,000 people organization, you have HR, you have systems, everything is in place. And the business is flourishing and it has a certain moat also. So I would say from a risk perspective, $10 billion company is a lot less risky than a $1 billion company, obviously. And if you select the stocks well, the chances are the same, whether a $1 billion company goes to 10 billion or the $10 billion company goes to 100 billion. So you get a better risk reward scenario. And moreover, a lot of companies these days, they are going IPO, like Figma is a very good example. It went IPO last week. It's a tech company. It's a tech SaaS company. In the past, tech SaaS companies used to go IPO when they were 1 billion in size, 500 million in size. Sigma first day valuation was $24 billion, right? And then it is expected to do well beyond $24 billion. So nowadays, a lot of companies that are good, they are coming into the market. They start at 8, 10, $12 billion market cap and then go up from there. And that is why we think that we are in the sweet spot. At $10 billion, that is when a company goes IPO, and then we can ride the growth of that company also. So that's another technical thing. And last but not the least, in this age of high media frenzy, what I have seen over the last 10 years is large caps get a lot of attention over small and mid caps, because small and mid caps, a broker is also not very incentivized to go around and sell a mid cap stock, because the volume is low, the commissions are low. And so the whole market dynamic is such that large caps are favored more by the market dynamics as far as the media is concerned, discussions on the media, brokerages who are promoting those stocks, the commissions that they get from that. So all of that builds up, and international investors. This is the time when maximum number of international investors are investing in the US. I saw the chart yesterday. I don't know the exact figure, but it was a straight graph going up, which means highest number of international investors are investing in the US right now. And international investors typically start with large cap, because small and mid caps are inherently risky. So there is not a lot of interest in small and mid caps. So the fund flows are also towards large caps. And you can see that in the returns. If you compare the S&P 500, which is the large cap index, to the Russell 2000, which is the small cap index, over the last 5, 10, 15, 20 years, S&P 500 beats Russell 2000 by a wide margin. It's not even close. Last 10 years, Russell must be 6% return. S&P 500 is about maybe 15 to 20% returns. So almost double the small cap returns. So A, you have lower risk. B, you have higher returns in large cap. Then what is the thesis for going into small caps? It's very difficult to justify that. Go ahead, Aishwarya, next question. Or Shrestha, sorry.
Okay, so any views on Figma?
Yeah, Figma, that's an interesting company. We like the stock. We don't like the valuation. It's as simple as that. You like an expensive car, you don't want to pay for it, but such is life. So I think we'll wait for it. We'll see how the stock performs over the next few days, few months. If it doesn't get to our valuation, for a few years also. And but that's our job, right? We try to find good stocks, but don't pay crazy valuations. The stock is up 250% or 300% in the last 3 days, right? So at that valuation, does it make sense to enter? We feel it doesn't make sense. We'll see, but we do get chances frequently. Like in the first week of April, when all these tariff drama was going on, the stocks dropped precipitously. Some of the stocks that we liked, they were down 30%. That was the time we got in at least 3 or 4 new stocks in April, because it gave us a chance to buy stocks which we thought were very expensive, we could never buy. But when they were down 30-40%, we immediately bought them. And so that's why we wait for such chances, and whenever we do get such chances, we buy them in the portfolio. As of now, that is not the time for Figma. I hope we get that chance soon. Go ahead, next question.
Any thoughts on US-India tariff war, as you've already specified it? Any thoughts on it's affecting US markets or anything?
It won't affect the US markets. India is a very small trading partner for the US. If you go to any mall or anywhere in the US, you will rarely find an item made in India. So US is not a big trading partner, especially for consumer goods. For services, maybe like TCS, Wipro, but that the average consumer is not concerned about it. So it doesn't impact the US economy at all. Even if the tariffs were, forget 25, if they were at 50%, nobody in the US would even know that Indian tariffs are at 50%, or they would not care. The economy certainly doesn't care. So yeah, no impact on the US for sure.
Lastly, a client is asking if this is the right time to top up, or any allocations should be added, or a new investor should be starting on right now.
Absolutely, we think this is a good time. Again, when we went through the macro part of the presentation earlier, 2 potent forces are at work starting in the last 15 days. One is fiscal stimulus from OBBA, the One Big Beautiful Act, and the second one is the monetary stimulus in the terms of rate cut, which is expected to start from September. And we think it's very highly likely that at least a 25 basis points rate cut will be announced in September meeting from the US Fed. So when these two combine, it's like a perfect time to invest in the markets, because chances of losing money at that point are very low, because you have two powerful government sources trying to prop up the markets. And when you have two powerful government forces propping up the markets, I would be in favor of market going up rather than going down. So simple as that.
Another question is any sector you think could surprise investors in next 1 year?
I think the consumer discretionary sector will likely surprise investors over the next 6 to 12 months. Because of slightly higher inflation, you should see some low sales or missing of sales estimates in the consumer discretionary space. And we have reduced our exposure to that sector significantly, because we do expect some issues in that sector. But outside of that, obviously, as I mentioned, some of the high-flying AI names, they may disappoint. Some of the hardware names on the tech side, they may disappoint because they were trading kind of in bubble territory to a certain extent. So some of the hardware names, I think what's happening in AI is we are moving from hardware to software. And we have discussed this theory many times, that anytime there is a revolution, the first few years belong to hardware, because you need the hardware to start using the software. So you take the internet revolution, you take the mobile telephony revolution. You start with hardware like Dell, HP, Cisco in the internet revolution, Samsung, iPhone, Blackberries in the mobile telephony revolution. In the first few years, they do very well. The next few years, once the hardware is around, belong to the software firms like Google, Meta, Facebook. All these companies did well in the latter half of the internet revolution. The first half, they did not do well because they just did not have enough revenues. And so we are in AI also, we are getting into that phase where the hardware story is pretty much done. If you think in terms of a cricket one-day match, out of a 50-over match, you are probably in the 40th over for AI. Versus for software, you are in, say, the 20th over. So there is a long runway for softwares to provide growth, versus hardware, you are in the last leg of growth as far as AI is concerned. And so those are some of the sectors where we are careful. But apart from that, yeah, we are good. Go ahead. Next question.
Okay. What are your views on open source versus closed source models?
Yeah, see, open source has been around since I was a software engineer, and that's a long time back. You can see I don't have any hair left by now. So open source has always been around. It works for academics. It works to a certain extent for smaller firms. It doesn't work for larger firms. Because if you are the CIO of a company and your software goes down, which is doing, say, $1 billion worth of transactions every day, if it is open source, God help you, right? Who is there to support you? Nobody's going to support you bring that software back online. So it's a no-no. Any reasonably sized organization, once they cross 25, 50 people where they have somebody heading IT, the IT guy will not want to take that risk. Because if the open source software goes down, who will he call? There is no number to call to, solve the problem with an open source software. Versus if it's a closed source software, there is a vendor who you can, call, and they're getting paid services revenues as a part of their agreement, that they have to fix that problem within a stipulated period. And then the IT person can tell their boss, okay, this is the time frame that our vendor who is providing that software has given us. They will fix this in 2 hours. They will fix this in 1 hour. They'll fix this in 6 hours. But there is somebody who has given a time frame. So as an IT person, I am not worried. But if an open source software that I have selected goes down, and if I'm not able to fix it for 2 days, and the company does $1 billion transaction every day, and the company loses $2 billion worth of transactions, that IT person is out of a job for a long time, right? So nobody wants to take that kind of job risk. And that's why open source works for smaller firms, academics, testing purposes, but for enterprises, even at a medium size, anyone above 50 to 100 people, open source doesn't make sense. Go ahead.
Okay. And lastly, what are your views about the energy sector with rising energy needs in US?
Yeah. So I think energy sector came back into limelight because of AI. Uh, the expected consumption of AI between now and 2035 in terms of data center electricity consumption is expected to triple. It's about 400 terawatt hours in 2024. It is expected to go to 1200 terawatt hours by 2035. So multiplied by 3 is the expected power consumption between now and 2035. So right now, data centers, about for the entire globe, they consume about 1.5% of the total electricity. Now in 2035, they're expected to consume about 3.5% of the total electricity. So it's a huge growth that we are going to see in terms of electric consumption from AI. And so people are very positive on the energy sector. The only issue over there being that this is a tech space that you are relying on. Things change every day. So a projection of energy consumption for 2035 could change in the split of a second if there is a new invention which reduces power consumption of a chipset, right? So that's the difficult part. I cannot trust a 2035 projection of electricity consumption when there are new large language models coming into the market every day, sometimes twice a day, right? So if those models or a new chipset reduces power consumption by half, then that 2035 projection may not hold at all. So that's the dilemma that we have. But otherwise, in general, the trend is positive. Now, how much the electricity consumption increases, we don't know. But it will increase, whether by 2%, 5%, 10% is what everybody is trying to understand. So, yeah. Go ahead, next question.
What's your framework for balancing the long-term innovation bets with these short-term macro headwinds like tariffs and rate cuts?
Yeah, so we generally go bottom up investing because we look at the stocks first. Only if we like the stocks, we will look at macro. So we will start with bottom up stock selection. If we like the stock, like the management team, like the revenue growth, once you like all of that, then you look at the macro. Okay, then you have to do sizing. I like the company, but if I like the company, I like the valuation, I like the management team, everything checks out. And then you look at the macro. And then if the macro is not supportive, then you either wait because you feel that you could get the same company at a better price, or you size it accordingly. So if the macro was supporting, then I was going to put 7% in that stock. Instead of 7%, I'll start with 2%. And then as the macro becomes more supportive, we will add to that stock over the next 6 months, 1 year, as and when the macro becomes more supportive. So those are a couple of ways to think about how to reconcile between liking a stock and the macro per se. Go ahead, next question.
What is one overlooked innovation or disruptive trends that you are focusing on and clients are not paying attention over?
Huh. That's an interesting question. I think one of the cosmetics one that we discussed, I think that can be in the overlooked category. That is something that people are not focusing on. Enterprise AI agents, I think that's where I think for some of the stocks, it's not built into the stock price at all. So that's one. Enterprise AI agents, we feel that what had happened in that industry is that there was a lot of hype last year, and then it took longer than expected for trials. Trials which were expected to finish in 3 months, it took 6 months because the companies who were doing the trials, they did not have all the data together. If you don't have the data together, AI agents are useless. And so instead of 3 months, it has taken 6 to 9 months for those trials to convert to actual paying customers. And people who were expecting results in 3 months, they got disappointed. They exited the enterprise AI stocks. Now the valuations are pretty low actually compared to some of the other AI high flyers. So I do feel that that is a place where as soon as those AI trials, which were going to finish in 3 months, they finish in 6 to 9 months and they start generating revenues, these stocks should start showing very well performance, because you will see the revenues also simultaneously. So I think that's one space where we feel there is an opportunity to be exploited. Yeah. Go ahead, next question.
Okay, that's it. That's the pretty much we have for the questions, and rest we have all the thank yous for the webinar.
Perfect. Thank you very much, everybody, for attending the call. We do have a recording. We will share the recording after the call fairly quickly. And we do this call on the first Saturday of every month at 11 a.m. So we look forward to seeing you, all of you actually, next month. Till then, have a nice month. Bye-bye.